Good day, ladies and gentlemen. This is Barry Norman, and welcome to our class on understanding charts, your roadmap to success. Now, today, we're going to start laying the foundation to how you would trade or use technical analysis. And all technical analysis is based on charts and images and movements and price action on charts. So unlike fundamental analysis, which focuses on finding a security's true value by studying financial statements, market outlooks, competition, macroeconomic events, technical analysis is based on the belief that past market trends can predict the future behavior of the markets as a whole. Now, if an investor can correctly interpret a chart's message and predict a security's movements, he or she can obviously make a lot of money. Certain aspects of technical analysis are controversial, such as the belief that markets move in trends that can play out over a long period of time, and the contention that market action can detect shifts in supply and demand relationships. But this is why it takes several classes. The idea to use a chart to identify trends and changes in those trends. There are several kinds of trends and patterns. So with all kinds of unusual names like rectangles, triangles, Bollinger Bands, inverted heads and shoulders, candlesticks, MACD, stochastics, and so on. Some technical analysis you also use indicators and oscillators to interpret trading data. But first, you need to understand how to use and read a chart. Now, a chart is your basic roadmap. It lets you learn the personality of an asset. Now, whether you want to use technical analysis, whether you believe in all of these other things, understanding how to read a chart properly, just a bare basic chart, knowing the different types of charts, and being able to tell a story of what's happened in the markets for that day. And that only comes from looking at a chart. You have to understand the bare basics. And then adding 2 or 3 intricate pieces of information, like a trend line, like volume, which simply tells you how many traders are trading that contract, because if people think Apple's going to go up and you see lots of people buying in the contract, lots of activity in the amount of contracts, the volume, you know that people believe the price is going to continue going up or vice versa. And then support and resistance. And these are the lines above and below, or the prices above and below where an asset's trading that should be the next level where a buyer hems and haws. All of that just tells you a story. It doesn't give you a trading decision. Now, for instance, if you're a technician or a fundamental analyst and you believe that Mario Draghi is going to say something in his meeting next week that's going to push the euro up, that's nice. You may be completely right. But how are you going to determine what point you want to enter the market, where you should put your stop loss, and at what point should the euro go up to? Because you're not going to get that from Mr. Draghi's speech. You're only going to get that from a chart. Now, technical analysis believes that investors en masse display much of the same behavior as investors that preceded them. Everyone wants to buy the next Microsoft. If the stock ever gets to 50 again, I will buy it. This company's technology will revolutionize the industry. Therefore, the stock will skyrocket. Actually, that's what they're all talking about Snapchat this week. You know, with that new IPO coming out, everybody's talking the same thing. But to a technical analyst, the human characteristics of the market might be irrational, but nonetheless they exist. Because investors' attitudes often repeat. Investors' action in the marketplace often repeat as well, i.e., patterns of price movements will develop on a chart that a technical analyst believes to have predictive qualities. Now, it's important to understand the realm of technical analysis is not limited to charting. Technical analysis is always primarily concerned with price trends. Anything that can influence the price trend of an interest is of interest to a technical analyst. As an example, many technical analysts monitor all kinds of surveys on investor enthusiasm or investor sentiment. which we call in a lot of cases the VIX, the fear monitor. Now, a technical analyst would be alerted that a trend might change when these surveys report extreme investor reactions. The logic being that in most investors are bullish, that when they have already bought in the market, anticipating the market will move higher, but that's because the investors are bullish and have invested. It's safe to assume that there are few buyers remaining in the market. Once you've entered the market, bought your gold, and your buddies bought the gold, and the guy down the street bought, eventually we run out of buyers and we get sellers. All of this is included in price action on charts. But before you can use any of it, we have to learn how to set up a chart and how to look at a chart. And like I said, if you want to do any of the other stuff, that's up to you. But at least a chart will help you make a decision. It will tell you the story about an asset. It will give you its personality. It'll draw you a roadmap. Now, whether you want to use a complicated atlas. Now, granted, most of us today use GPS, so when I talk about roadmaps and atlases, it's over a lot of people's heads because they've never actually used a map or an atlas. But when I started driving, we didn't have GPS. We used to have roadmaps and atlases. So when I'd be going across town to a meeting, I'd have to make, I'd make a phone call and ask them for directions. Now, once we get directions, we might get lost. So I used to call and get directions. They tell me take the 405 north and get off at exit 15. I'd write that all down or keep it in my head. And then they said go 3 blocks, turn right, go 3 blocks, turn left, go 3. And you know what? I wouldn't write all that down and I'd get lost. So I'd end up getting off the highway and pulling into a filling station asking directions. Or calling again saying, how do you say to get there? Where my business partner in those days, he carried an atlas in his glove box, and he could get out this atlas, and he would get you right to, not only would he get you where we were going, he'd get me in the right lanes and the right highways and get me off on the shortest route and get me exactly where I wanted to go. So this is why a chart is so good. And the more information you put on the chart, the more apt you are going to get to where you want to go easily and successfully. Now, excuse me, some person's written in a whole bunch of messages here. There is nothing in this webinar description, it's called Understanding Charts, about Elliott waves at all. Today we're talking about basic charts, and that's all we're going to be discussing. Okay. So for those people or this person who's writing in all these comments, you should come to the class on Elliott waves. Now, most investors tend to either be technicians or fundamental analysts. And though many analysts believe that combining technical and fundamental analysis is the best way to evaluate entry and exit points. And what I am is I am a technician who uses fundamental analysis. Okay. So since many people believe in technical trading rules, at the very least, the rules can become self-fulfilling, making them important to know to an individual investor. So let's just start out with getting the bare basics or the primer on charts, because that's where we got to start to build our roadmap to success. Now, when we start out, there are basically 3 types of charts. That's it. There are line charts, there are bar charts, and there are Japanese candlestick charts. Now, there are all types of other variations that have come off of those 3. And today, because of computerized charts, computerized all this stuff, all these weird things have come out of it. But the 3 basic categories are line, bar, and candlestick. All the other ones are gimmicks. And that's what they are gimmicks. Now, the first and the most basic chart is called a line chart. And a line chart looks just like what you're seeing up on your screen there. There we go. And a line chart is the bare basics. You can see how price is moving in a general viewpoint. Okay? You don't see any specifics. Now, all charts rely on price, so the prices don't change. This chart is full of prices. Now, what we're looking at is the Euro-US dollar 30-minute chart. A 30-minute chart tells you that every 30 minutes, a dot is put on the chart for the end of the price or the close of the price at the end of that 30-minute period. Now, before we go off into variations, there's some charts that offer median price. There's some charts that offer opening price, but it's one dot put on every 30 minutes, and 90% of them are always the close. That means at 1 o'clock in the morning, you put a dot on the chart. At 1:30 in the morning, you put another dot on the chart. 2 a.m., you put another dot. 2:30 a.m., and it's that price which will be offered in the charts. Now, so in a 30-minute chart, we just put a dot on, and then we've connected the dots together to draw a line on the chart. And that is the bare basic information that you get. That's like me if you ever got an invitation to a wedding or to a restaurant, and the back of, or to an event, on the back of it had this little line that got you to off the highway and into their parking lot, and so you can find the parking lot. That's what it is. It's just a bare basic line. And this is what we have in a line chart. It shows you where price is moving overall, but it doesn't give you any specifics. From here we go to my favorite, and what is overall the market's favorite, and that is called a bar chart. Now, this bar chart is exactly like we're looking at the Euro-US dollar 30-minute chart for the same exact asset. This is the same chart, same time period, same price movement, and my buttons are moving backwards for some reason. Okay, there we go. And this chart gives you a lot of information. We put a bar on this chart every 30 minutes. And that 30 minutes gives you the open, the high, the low, and the close in that 30-minute period. And you can visually see how price moved. You can also start to see some commonality. You can start to see actually price trends. You can see tops and bottoms. You can see more distinct patterns you can see this huge gap down in price. You can start to see where a price has a significant amount of resilience, where prices reacted many times as compared to the line chart. Because none of this do we actually see in great detail in the line chart. We just simply see that the price is falling down. We don't see any prices that are in common. Now, each one of these bars on a bar chart gives us 4 pieces of information. It gives us the open, the high, the low, and the close. And they're sometimes referred to as an OHLC. Now, they're very simple to draw. You simply put a doohickey, a dash, to the left at the open. You put a dot at the highest it reached in that period, a dot where the lowest it reached in a period, and you put a dash across to the right for the close of that period. Okay. Then you connect a line between the high and the low, and that gives you the bar chart. Now, if you stepped up or you climbed up the ladder from the open to the close, that is a bullish time segment. Not tell you how the markets are moving, it's just telling you it's a bullish time segment. And it tells you that the bulls were in control in this time frame. If you do the opposite and you put a dash, you still do the dash to the left for the open, but when you put the dash to the right for the close, you step down the ladder from the open to the close, that is a bear sentiment. So that tells you that the bears dominated the market during that session. Also, we can see in the size of the bars how active the market was. What was the variance between the open, the high, the low, and the close? We can start seeing actual prices, because if a price closed at this and the next time its low hit that, the next time the high hit, you can see that that one price, regardless of how many times it was touched, was a significant price, that it got action from the traders. It starts telling you a story. And because all of trading is visual, all of technical analysis is visual, you need to be able to start seeing this stuff visibly on the charts. Now from here we go to what has become the most popular type of chart in the marketplace. And unfortunately, for retail online traders, it has become too popular. Candlestick charts has become the buzzword. And everybody wants to say they've used candlestick charts. Now, candlesticks have been around since the 17th century. They are an old established trading method that was started by rice traders. Okay. But the fact is, it is a charting display method and system. And these candles are painted in reds and greens or blacks and whites, or today the charts allow you to do just about any color you want. But you have a bearish and a bullish color. Now, the bearish and the bullish colors don't really tell you much. But we are human beings, and as human beings, we have a psychological bias to these reds and greens. So when we see lots of reds or we see lots of greens, we then can start to form opinions. And the thing about candlesticks is not about the reds and the greens. And this is where people go afoul of candlestick charts. Candlestick charts are great, but they're identical to bar charts, except for the reds and the greens. Now, the interpretation of the candlesticks are based on the length of what's called the wicks and length and shape of the bodies of each candle. As you notice here, we have candles that have virtually no body. Okay. And these have names. These are called dojis. And then we have other ones that have very long bodies. We have ones that have no tops and no bottoms. And each one of these candles has a name. And each one of these candles has an interpretation. And then there's and where that candlestick is positioned then has an interpretation. So if you want to use candlesticks, and they are a wonderful trading tool, you have to learn to read them. And this means you have to put the effort in to master candlesticks. Okay. Now, we just finished a 3-week course on candlesticks, and there's lots you can read, but you have to understand what candlesticks are. You have to know what a harami is. You have to know what a marabuzu is. You have to know what 3 black crows are, 3 white soldiers, 3 in, 3 out, because otherwise you're just going to be looking at reds and greens and make terrible mistakes. But these are the 3 general types of charts. Now, I'm going to interrupt again because you guys are writing a lot of messages, and I can't read them as fast as you're writing them. And the class is on a very restricted time and on a very restricted subject matter. But I'm getting some things from people like their screens aren't changing, or somebody just told me the sound disappears all the time. Well, you all tell me this, but you see, there's nothing wrong on my end. Okay. You all have computers, internet connections, Wi-Fi. If the sound is going in and out on your side, it's basically due to your Wi-Fi. Okay. So you can either log out and log back in. You can try your refresh buttons. Okay. But it is not on my side, and there's absolutely nothing I can do. I can see this software provides me all kinds of monitors. I can see how strong the sound is being projected out. I see how positive my internet connections are. So therefore, it's on your end. Okay. So before you type in all these messages trying to put the blame on me, go fix your or check your systems first, because most likely we have 300 people in this class, and most of them are hearing and seeing just fine. So I'm sorry to interrupt, but I'm getting lots of these messages, and the people are getting almost nasty about this stuff, and it's not on my end. Okay, so let's go on. So these are the three basic types of charts. Now, again, on a candlestick, we simply, and it's very much like a bar chart, we put a line across at the open. Instead of just a dash, we put a line across at the open. We put a line across at the close. We put a dot to the highest and a dot to the lowest, and we connect these dots to what's called the body of the candle. And then we color in this body. These are called wicks or shadows, and these are the body of the candle. If we stepped up from the open to the close, again, that's a bullish time frame, and this candle would be then painted with the bullish color you selected. In most cases, it would be green. If it was a step down from the open to the close or a bullish time frame, you would paint this candle with the red. So this is, if you notice, basically the same thing as an OHLC, except it just leaves the color off. Now, candlesticks, though, involve all kinds of interpretation about how large this body is, how big these wicks are, and then where they are in relationship to the next candle. Like one of the most well-known is called a harami, and when this next candle is all contained within the body of the previous candle, harami means pregnant, and it looks like a pregnant person. And therefore, that tells you something. But you have to know what these are. So these are the different types of charts. Now, each chart tells you something different. My recommendation to everybody today is to use bar charts, because the new modern charts, and we're going to go over and look at some live charts, simply allow you to click a button and change it to Japanese candlesticks in a second. Doesn't change anything. So you'll find that drawing trend lines and putting indicators on charts that aren't colored, that are just the black bars, make it easier, and then you can flip them over to candlesticks. Very, very simple. So this is where we go from here. Now, once we've set up the type of chart we want to look at, we have to look at what's called a time frame. A time frame, like we were looking at the euro US dollar in a 30-minute time frame. And that time frame is what is contained in that particular price. Now, time frames have two effects. Number one, we want to look at time frames that fit our type of trading. If we're a day trader and we're trading in short-term periods, or we're a swing trader, or we're a long-term investor, we want to look at different time frames that fit our trading style. So you can look at a 15-minute chart, you can look at a half-hour chart, you have 1-hour charts, you have 3-hour charts, you have 4-hour, you have all the way up to 1-month charts. Now, the fact is, it's your choice. Now, viewing an asset in multiple time frames can be very, very helpful, because if you're looking at, hypothetically, oil in a 15-minute chart, we can only see oil over a very short period of time, because your chart has the same amount of size in your screen. But it means if you're looking at 15-minute oil, that every 15 minutes a bar is put on the chart. And there's only so many bars that are going to fit across the front screen that you're looking at. And you're going to see that oil in the short term has been trading in an uptrend. But if you put oil back and you looked at oil in a 1 hour chart, you might see that, yes, this is an uptrend, but it's a short-term uptrend of a longer-term downtrend. And then if you went and looked at oil in a 1 day chart and you're seeing the last 60 days of oil on your screen, you might see that maybe it's a downtrend, and that downtrend had a medium-term uptrend, and now it's got a short-term recovery. And you understand more about how that asset is moving. So viewing the currency pair in multiple time frames is part of the process of viewing its personality. Understanding the currency pair personality can help you in your success with trading. So let's go over to some live charts, and let me just show you these things on some live charts. So let me pop them up for you. And they'll be up on your screen in a second. Hold on. So we're going to be looking at the euro US dollar, and we're looking at it in right now a 30-minute time frame. So we can see the euro US dollar. Now, what we see on this chart is 1 day, 2 days. We're going all the way back, and we can see back to the 17th of the month, because that's all that we can fit on the dynamics of our screen. This is always, now, that doesn't mean you can't go back farther. You can take any chart and pull it back as far as you like to see how it has been trading. Okay. But what's important is what you can physically see on your screen. So we can see that the euro is trading in a short term or a current term uptrend. We can see in a longer term it's been a downtrend. But wouldn't you like to know if this is just a simple recovery and how long this downtrend was and what price it fell from? So this could simply be an adjustment. It could simply be a rebound. Okay. We also see in the short term, in the very short term, it's trading in a downtrend. Now we can define these by changing the time frames. By changing this to a 15-minute chart, we might now get some more detail on this downtrend. The prices don't change. This is what too many people get mixed up. When you change time frames, the prices don't change at all. Okay. The prices remain exactly what they are. Okay. Except the bars change, because when you're looking at a 15-minute bar, okay, that is what that price did in 15 minutes. Now, that price in a 30-minute bar could have had a much higher high and a much lower low, and you didn't see that precisely in that half-hour chart. So by breaking down that half hour into two 15-minute segments, you're seeing more detail. But also, you now are only seeing back on your chart to the 22nd, because there's still remains the same amount of lines that can be put on your chart. Now, to get a better understanding of this asset, and we want to know where the euro has actually come from and go to, let's go to a 1 hour chart and look at what we're seeing. We're seeing now a whole different story with the euro. We can see the euro was in a downtrend, recovered somewhat, reversed and came back to that downtrend, and look at the commonality in prices. We can see actually start to see some common price levels, bounced up and is now recovered to only about halfway of what that downtrend was overall. If we go back a little bit farther to get a better perspective, we can now see that uptrend, the highest price the euro has been in a month since the beginning of the month, was at 108.27. And it really has been in a steady downtrend all month long, because you have short-term, medium-term trends within a longer-term trend. When you're trading, day trading, you're more concerned with where price is today and where it's going today. When you're doing swing trading and you're looking to buy something to hold for 30 days, you're more concerned with where it's coming in this overall price trend. And knowing this asset over different periods of time will help you better understand the personality of the asset and help you better understand what is happening with that asset in the long term. Also, looking at an asset in multiple time frames will also help you see potential trading opportunities. You might see that maybe the euro at 11 to 12 European time always has a dip in price or always has an increase in price. You might be able to see what we call lines of support and resistance. These lines of support and resistance are very important, and there are many ways of getting this support and resistance lines on your chart, but the first one is what we call eyeballing. And what you're looking for is simply prices on the charts that have had a commonality over time and where the price has reacted to a certain price. So when we come down with the euro, and we simply can eyeball these on a chart. There's several ways to get support and resistance, but the more ways you get it, the more important it is. And what you're looking for is, if we look at just the current price of the euro, draw a line back here, look at that, look what happened here. Look what happened here, we had an open, look what happened here. Now, it doesn't have to be above or below. It got to this level and bounced off here. Look at how many opens and closes we have here. Now, going back a little bit farther, we see something else here. We go back a little bit farther in the month, we see something else here. That tells you that this 105,624 is an important price point to the euro. It tells you that this is a level where buyers hem and haw. Doesn't say it's not going to break through, doesn't say it's going to bounce off them, doesn't tell you anything. It tells you that this is a price that you might get a reaction. And you're not trying to come up with something better or smarter than the next guy. You're trying to come up with where the markets, the mass psychology of the markets will react. What price is going to be important to those million traders around the globe? If you can predict what price will be important and that you can expect some type of price action at that level, you can then wait for that price action because you know you know that there should be an action. When you can see how the market's reacting at that price level, you can then take your proper action. Or if you want to set entry and exit points, these will help you develop your entry and exit points. But before we even get on to support and resistance, we have to talk about putting some basic information on a chart that will help you take your charting to the next level. It will help you not make trades. It's going to help you understand. It's going to give you some reason to look at charts because you don't have to take it any farther than this. If you can put volume, support and resistance in a trend line on a chart, actually that's a whole trading system, but that will then help you make a decision when Mr. Draghi says he's going to cut back QE and that's going to send the euro flying. We can't tell if the euro is going to go to 106, 107, 108, 109, 110. We don't know what the reaction will be, but as it's moving up in reaction to what he is saying, we expect price levels. And when it comes to that price level, because price doesn't move in one straight direction. It always moves in hems and haws, peaks and valleys. So if he starts talking positive about cutting back QE and we start seeing the euro go up, we are going to wait. We saw a line of resistance or a line of support at 106.50. We're going to wait we're going to see it get to that 106.50. Now it can break right through there, but most likely it's going to bounce off of, bounce up to it, bounce off of, and then go right through it because there will be buyers and sellers buying and selling at that point. Okay. When it starts moving through there again, will it go to 107? This is what the understanding the market is all about. Predicting whether an asset will go up or down, that's not difficult. Believe me, it's not. It's understanding the swing of the market, where you can put your stop loss, where you would target your take profit point, how can you protect your loss, how can you minimize your risk, at what point should you be entering the market, and at what point should you be exiting the market. And this you can't get from anywhere else but your charts. That's it. But you have to learn the basics of how to use a chart before you can go on to the other stuff. And the biggest thing that most traders come to me with, and that I hear about all the time, I mean, I can't tell you how many emails I get from traders, not complaining about me because I don't have anything to do with trading platforms, but they're complaining about brokers rigging their platforms, brokers taking their money, brokers, hold on a second, brokers taking advantage of them. But it's not the truth. Okay, what happens is most people can't predict the swing of the market, and they get stopped out, and their trade closes with a loss because they put their stop loss too close. They were so concerned with making huge profit, they never figured out where to put the stop loss in relationship to the swing of the market, where the support levels were, what the volatility in the markets were, and you only get that off the charts. So one of the best reasons to learn how to read a chart properly is so that you can apply technical analysis. Not every trader believes in using technical analysis, but it can be useful, even if it's not your primary method of trading. Technical analysis relies on prices that is on a chart you are using. Most charting systems allow you to add technical analysis as an overlay on your charts. And the more information you add, the more likely you are going to arrive at your destination successfully. Now, here we were looking at a roadmap of London in the background. Tell me something. Does it look so much different from this map of natural gas? It almost looks the same. They both look totally confusing at the first glue. Now, once you have these, though, you can start reading them and understanding them to make smart trading decisions. So let's go back to the live charts. And let's take a look at, so if we were to use the euro-US dollar, the next thing we'd want to do is we drop volume on here. Volume's this blue line underneath. Okay. There is a relationship between volume and price movement, especially when prices are trending. So first you have to determine what the trend is. Now we have an entire class called The Trend is Your Friend to teach you how to draw trend lines on charts. And trend lines have rules, and these rules are very important because you want to draw your trend line exactly like everybody else's. Because I actually just put a trend line on here for you, and this trend line follows all the rules. It happens to be that today's price of the euro sitting right on that trend line. It's very rare that it happens. But a trend line must have 3 points in common using swing lows. So in an uptrend, you draw your trend lines underneath. But here we have 1, 2, and you have to have a third point in common to what we call activate or validate your trend line. Okay. Once that occurs, you then have an active trend line, and you can use that to predict your prices. Okay. Well, we would expect the natural movement of price to move with volume. Now, if we can look on here and put our support and resistance lines on here, and like I said, we get support and resistance from many different places. But like I said, the first and oldest one I use is called eyeballing. And we did this just a second ago. We eyeballed this line right here as being a significant price. Now, what we've done is we can actually do two things. We have a triangle forming, which a triangle shows a pent-up demand in price. We're also looking at how significant this price is, and we're starting to interpret what is happening in the markets so that we can predict direction and momentum and start looking at price levels to determine entry and exit points, or do you want to trade this asset? But that's not for this class. Today's class is about basic charts, and we started you on the road to these basic charts. Now, my recommendation to everybody out there is to take an asset, one asset. I know all of you guys want to trade everything. You want to look at a billion charts, do all that on your own. Take one chart, one asset that you really like. For somebody, not something you want to trade. You're going to Australia on vacation, so take the Aussie USD, the Aussie EUR. You know, you like gold, take a gold chart. You like oil, take an oil chart. And start building all of this stuff. Do all your other stuff, however you want to trade. In the meantime, start building your oil chart. Start looking at a different time frame. Start trying to find your lines of support and resistance. Start putting your trend lines. Start looking at the relationship of volume. And come to our other classes on technical analysis and learn how to start adding these into making trading decisions. Okay, like I said, do all your other stuff. Do this on one set of charts. Look at that chart every day. Start trying to tell a story of the chart. Start trying to tell a story of who's controlling the market. Start understanding exactly what you're looking at. Start building your roadmap. You know, say you just moved across the country. You moved from London to Manchester. Now you've got a new house. You need to find new stores. You need to find your way to the office, and you want to start building. You know, so now you know what streets, how to get to your office parking lot every day. But now you want to start building so you know what time the highway's busy, what time, maybe if there's an accident on the highway, what exit you get off. Maybe you can take a side road, or if you see a street bus and a garbage truck on 3rd Street, that you can go down Maple, go up Elm, and come back out in front of them. And this is what you're doing. You're starting to learn all about this asset. And take this one asset, okay? Because once you've learned how to master this and master your chart, you can then apply it to all of your other charts. And like I said, if you want to trade with candlesticks, look, we simply build all this on the bar chart, and we click on candlesticks, and we have all of our detail of candlesticks. It's not that difficult. Okay, so thank you very much for joining us today. I've got to run because I have another class in a few minutes. I've got to get set up. Thank you all very much. Enjoy the rest of your Sunday, and have a great trading day. Thank you very much, and we'll see you again next month, I guess. Bye now.